morning, everybody. I would like to welcome you to the Fred Report conference call for September 30th, 2001. Obviously some interesting stuff going on, and we'll get right into it. The first thing I would like to talk about is the stock market here, and there's a couple of good things going on. And I guess the first one is the S&P is slowly rallying and going the direction we thought it might go, which is good. And, you know, obviously people are pointing at the problems. They're saying there's not volume. The breadth indicators don't look so great, and that's actually not true. The breadth indicators look fine. New highs, new lows is maybe falling off a little bit, but that does happen sometimes a couple of years in advance of actually getting the market into trouble. I'm hearing things like, well, you know, we can't go up, but since we have gone up, it's not going to go up past this window dressing business at the end of September, and October is going to be lousy. And in fact, I think the market's looking pretty good. It's just a little slow, and I am getting calls from funds and things saying, golly, I've fallen about 5% behind the S&P. It better come down, or what do I do? So my guess is if we don't start to come down in October, we could start to see this market do a little bit better and some volume and stuff come in. Want to note today is very interesting for a couple of reasons. First of all, the IYT, the Dow Jones Transportations, today is making firm new highs for this move and will make a new closing high again for this move. We already had a new closing high a couple days ago for this move, but it's actually trading up pretty good and has broken out above all of the August and June resistance. So that's a positive. And the other thing that has happened is the Russell 2000 ETF we follow, the IWM, is very slowly also trying to do the same thing. So we have a chance to close everything on new highs and such today, which is the last day of the month. Now, a number of people have asked, well, you had a buy signal back in July suggesting we were going to be up until September 30th. And we are, and now what? And the only thing I can say is when I look at most of these chart patterns, the market does not look like it's building a giant top here. It actually looks like it can continue. Obviously, we are a little bit overbought short term, but the intermediate term stuff is not super overbought. All the moving average systems are quite positive, and that's on every index, and it looks like we've got a good short-term uptrend going. And as I say, if we don't get knocked back here significantly in the next couple of weeks, and frankly, that could happen, but I'm not really expecting it, to be honest with you. I think we're actually going to just keep going up and see this market go up into the end of the year. Should that occur, I think a lot of people are going to have to chase it. I talked to a couple of people yesterday about short interest. We are seeing some of the shorts cover, but there are plenty of shorts out there, and sentiment indicators are still elevated. Percent bears was 27% bears last week. We contrast that at the last high with about 21% bears. So all told, I think the conditions are still present for advance. Let's take a quick look at the bond market. The TLT has now gotten overbought again after being oversold and rallying. It's rallied up to that 106 area, which is key where it ought to turn down, and frankly it has turned down, and I am still forecasting a drop in the TLT and a rise in rates into the fall. I cannot wait to see my accumulation model. That is a weekly model. I can't wait to see how it looks and see if it looks like it's going to break down on this next drop in the bonds, which we're starting. That could certainly have happened, and that would lead. Recall that market has not signaled that we're going to break the uptrend yet through my accumulation model or through the trend lines. But I think it's important to realize the markets are also saying that the bond market does not have to drop precipitously for the stock market to rise. Both can actually go up, and I would also point out, once again, if I were a bond investor, the corporates do look still more stable and more interesting to me than the treasuries. And I also note we're getting another run in the high yield area, which suggests that credit fears continue to abate. If the HYG can make it much through 90, and currently we're at 89.42 roughly, that could go on to a breakout mode, and that would be a big positive, I think, for credit type stuff and for the markets. So bonds suggest that we're okay, actually. Gold is interesting here. The GLD has not hit the 130 area, but gold traded 1,300. My accumulation model here suggests that gold could run into a little bit of trouble in here. And 1,300 has been my target. So what I would tell you guys is I would not be overweight gold here. I would take some profits in gold. Obviously keep a gold position. That remains one of our very favorite long-term investments here. But if you're big overweight in gold looking for 1,300, we've gotten to 1,300. It's time to sell some of the gold and get back to a normal weighting. When I look at silver, silver has still outperformed gold, which is generally not so good. If I look at the chart of silver objectively, it's a beautiful and classic Richard Pryor formation that it broke out of. Everyone knows what the Richard Pryor formation is by now, but for new people on the call, that is basing ready to catch on fire. We had a nice base in silver from basically May to September, a breakaway gap to the upside, and then new highs. So silver still looks healthy, but within that context, on the SLV, we could see that pull back to 19 to 1960 and still be a nice uptrend. So I'm just not wild about the metals here. I think they fulfilled some of the promise that we saw for them. Looking at the currencies here, I got to sort of say I messed up a little bit on the dollar in that on the whole dollar rise, we thought that the dollar could end up being weaker on the downside because the rise took so long to happen, and we wrote about that while the dollar was going up. Yet for some reason, as the dollar came down to 80.81 and then rallied again, I sort of didn't emphasize that. And now we're seeing the dollar at much lower levels and much weaker than I thought it would be short term. The intermediate term picture on the dollar is still about the same. And one of the things to look at on the dollar is if you look at a big weekly chart going back to November, it's very, very possible that the dollar has built a head and shoulders top, with the period February, March, April being one shoulder, the move up to the double top at 88.50 being another, and this latest move, July and August, the little rally we had, being another shoulder. And as long as we stay below 80.81, that is actually a possible interpretation. And if that's the case, the dollar is going to go make new lows. What that can mean for us is, first of all, the euro, which has been a little bit stronger than I thought it would be, can continue up. And the euro has basically got resistance on the FXE in the 136 to 138 area. We're right there. So if we're going to get a dollar bounce, this would be a good place. The Japanese yen on the FXY, I thought was going to fail at 115. There was some intervention. It came down to 115, but it's not failing. If I'm going to be right on this yen, it's going to have to turn down by next week, frankly, or I'm going to have some egg on my face on that one. But what that means for our stocks basically is we could see the big cap stocks start to do better because they have multinational earnings. Stocks like McDonald's and Coca-Cola tend to do better than domestic stocks when the foreign currencies are strong and the dollar is weak. So, and furthermore, if you look at the research on small cap stocks leading versus large caps, that's about a 2-year phenomenon on average. I thought it was going to be more this time, and I'm not saying we're going to have small cap stock weakness. They are still on an intermediate basis stronger, but that differential may lessen. Realize that the S&P mid-cap index got to within 10% of its all-time highs on the April rally. The S&P got nowhere near that. But right now it looks like the S&P actually can lead a little bit. We just need to watch that and realize that may be what's occurring.